we have in the middle of us now Chris Lanning, Managing Director and Co-General Counsel, General Atlantic Partners. Vaibhav Parikh, a partner in private equity M&A. Nishchal Joshipura, also a partner in private equity M&A. Ruchir Sinha, co-head of private equity and private debt investments. He has also specialized in REITs, by the way. So if some of you have REITs questions, we'll be happy to address them. There we go. Are we all ready? Thank you. So I think let me start with Chris. I think he is industry doyen to us and has tremendous experience in India for a long time. And I believe he worked all the way from Daksh days and other ones. What is your experience in India, Chris? And what are your thoughts on investing into India? Not too difficult a question, I hope. Thank you.
I'll say my experience is good, not great, to be honest, right? So we made I'll just give you just a brief background. General Atlantic is a global growth equity firm, so we're not an India-focused firm. We actually invest across the globe, but we do have a significant presence in India and have been investing there since 2003. I think we've made about 14 or 15 investments since 2003, so we have quite a bit of experience there. I'll say that looking across our global portfolio, our Indian investment portfolio has performed okay relative to everything else we do. I think that's a little bit of function of the missed opportunity in India in general. I feel like the last 10 years India has not lived up to its potential, and a lot of the sectors within India that we would like to be investors in and where we could have driven outsized returns on have not performed. That being said, we do have the ability to find growth even in a market that's overall not performing well, and we've done extremely well, starting with the outsourcing space, in the early 2000s, moving through a number of IT situations, and today we're much more focused on the Indian consumer. We know it's coming. There's evidence of it coming. We see it in a number of places. We think there'll be a rotation of investment out of gold, which is where a lot of the assets have gone because of the unfortunate inflationary environment in India. So we see them going into more traditional investment products, so we're very focused on that space. We think that's quite interesting. We think the next generation of IT, so more specialty-focused IT, focused on the things that are really driving innovation globally, like the cloud, mobile. So a lot of the entrepreneurs that have come out of the early successes in India in the traditional IT services firms are now finding a new home and new opportunity to really be specialists within that space. And the other one we think is very interesting is healthcare. There's a lot of derivative beneficiaries of the improvement in healthcare in India and, frankly, the ability of people to spend on healthcare in a private setting. So the other comment I would make is that, as I said, we're a global firm, so I have Europe, Brazil, China within my portfolio. India, unfortunately, takes a disproportionate amount of my time. It's a difficult place.
Absolutely.
For us. And as a lawyer in the firm, I prefer not to be spending as much time on some of the issues that I have to deal with. But on the whole, we're very positive about the Modi momentum, and we think we have to be a little patient. I think it was a little unrealistic to expect him to come out of the box with a new budget and accomplish everything. But I do think, and the firm believes, that we'll get back to 6-7% GDP growth, and a lot of these structural reforms that, frankly, just stalled for 10 years. We think there's going to be some very positive momentum on, which will create investment opportunities for us as well.
Yeah, actually, we have learned very hard lessons in the last some years, and that has brought India to what it is today, and that's why, there is a sense of optimism at this point in time. One other thing that seems to have happened is that the whole socialistic mindset that we used to think, now there is no shame in talking about capitalist kind of, conversation. So I think that's, I agree with you that experience has not been that good, but we are just ever optimists, so
Well,
eternal.
that being said, I mean, we're long-term investors, so.
Yes, exactly.
We have made the commitment to India since 2003. We built our team there, so we believe in the long-term picture in India. The
Absolutely.
short term has not been as good as we had hoped it would be, but we're there, and we think over the long term it's going to be a fantastic,
So thank you so
fantastic place
much.
to be an investor.
Vaibhav, a question for you. What is important to know about the regulatory regime governing private equity investments?
I think Sridhar said it very well. It is so confusing to do business, simply because there are a lot of regulatory nuances, regime, which generally you don't find in other parts of the world. One such regime, for example, is exchange control. India still has exchange control. So a lot of time when funds set up, and they have a couple of term sheet with them, they're looking at investing, they say, hey, I've got a couple of term sheet. Tell me, how can I invest? I think that's the question which starts when you look at what a regulatory regime. Simply put, because of exchange control regime, whenever you want to invest, you have to look at how do I invest. There are generally three ways of investing for venture capital. One of the most direct and simple way is what was told earlier is foreign direct investment, or FDI as popularly called, where 99% of investments are based on automatic basis, which means you don't require prior Indian government approval for investing into India. There are few sectors where there are prior approval required, or they are restricted to a certain percentage. For example, telecom, where 49% is on automatic basis, 74% investment you can make after getting government of India approval, but you can't go beyond that percent, or you can go up to 100% in telecom, but in some of the other sectors you can't go beyond 74% or 49%. For example, in defense sector, which has recently been opened up, you can go up to 49%. There are some sectors which are prohibited completely, for example, gambling, retail trading. Some of those sectors are not open, but 99.9% sectors are open for investment. So where is the issue? One of the biggest issue comes from exchange control perspective is on pricing guidelines. When you make any investment in India, there are pricing guidelines which apply. When you exit from India, there are pricing guidelines which apply. Just to give a little example, when you're making investment, government expects that there's a minimum price you will pay, which is based on a particular valuation. Till last week, it was based on DCF valuation guidelines. Thankfully, government, in the spirit of liberalizing it further, has now said that pricing guideline will be applicable, but you are free to determine whichever internationally accepted methodology which you want to use. So as long as there is an internationally acceptable methodology, you are free to use that methodology for determining what is the minimum price you need to pay for getting shares of an Indian company in a primary transaction, or getting shares from an Indian person in a secondary transaction. So that's something which is a good liberalization. One major reason being that when you are looking at a DCF method for valuing a company, you are heavily dependent on company to give the business plan, the cash flow, which is going to be used for purpose of making valuation. And that's something you are now no longer dependent on. So that's been a positive liberalization which has recently happened. Secondly, when you're looking at nature of investment which you make, the instruments of investment which you make under foreign direct investment, the law says that you can invest either as an equity or compulsory convertible instruments. Compulsory convertible instruments can be either of preference shares, which is somewhat like preferred stock, what you are used to investing in the US and some other parts, or it can be compulsory convertible debentures, which is more like a debt instrument which is compulsory convertible. But anything which you use has to be compulsorily converted into common equity shares. I think that has been the key aspect, which means that you can't have, you know, redemption or putting your shares to the company and getting the amount which you invested back. Going further on other areas of other routes of investment other than foreign direct investment, one route which Richie mentioned in earlier session is on foreign portfolio investment, which is primarily used for investment into listed companies on a stock exchange, which otherwise foreign companies are not permitted other than through foreign portfolio investment regime. But the key beneficial regime which we have seen in last 8 to 10 years has been on foreign venture capital investment regime, what we call FVCI. FVCI says, you know, because you are a specific set of investors, we will give you certain benefits as long as you invest now under the current regime into 10 sectors. If you are investing in the 10 sectors, then there are additional advantages or benefits which this regime give you if you are registered as an FVCI. Some of these benefits are no pricing guidelines are applicable, which means that there is no entry pricing or an exit pricing which is applicable. That's something which we find it to be very, very beneficial. A lot of the terms which you would put in your agreement with respect to anti-dilution, with respect to your put option, liquidation preference, etc., are now, there are more chances of that being enforceable. Secondly, under the FVCI guidelines, there is no, if your portfolio company goes public and if it held on for a period of 1 year, then there is no lock-in, which otherwise mandatory applies to pre-IPO shareholders. So that is the additional benefit of FVCI. The third benefit is that, as I mentioned under the foreign direct investment, you can invest only in equity shares or compulsory convertible instrument. In the FVCI, a certain portion of your investment can come as optionally convertible instruments. And this is something which gives you a lot of benefit. You can invest as convertible debt, which you can redeem, and some of the structures which otherwise are not possible under the foreign direct investment may be possible in this particular investment. We are hoping from regulatory perspective to see more and more simplification to come in. One good part which has been conveyed, I was talking to Minister of Information and Technology and Justice Minister a couple of weeks ago in a NASCOM meet, and he mentioned that one of the target which Prime Minister Modi has given to all ministers is that India, which currently is ranked at 134 in ease of doing business studies, which the international body does, he has said by the end of the year, he wants to see India in below 100, so from 134 to below 100. So that is a step, there is a measurable target which the Prime Minister has put in for all the ministers, and that, in my view, will drive a lot of steps which each ministry will take from regulatory perspective to making things easier and certain for investments.
I think that should at least give some answer to Sridhar, because I think you made a very valid point. With all the great things around you, you've got such regulatory environment which makes it very hard to do business in India. And just the same thing was echoed by Chris. But let me just move on to another subject of debt. And my question to you, Ruchir. Ruchir is a head of private equity debt practice. And what are the regulatory framework, what is the regulatory framework for debt investments, by the way?
Sure. I think traditionally, the Indian regulator has been very averse to debt. And, any amount of foreign debt that was coming in was heavily regulated and typically qualified as external commercial borrowings, which were subjected to very stringent restrictions, almost making any amount of foreign debt putting into India very, very difficult. But I think over the past couple of years, India has opened up to private debt or foreign debt like never before. And I think it's not just been from a regulatory perspective, even the tax authorities, and I think that's probably the best determinant of seeing where is the government focusing on. The tax department has also reduced the taxes on interest or coupons from 40% to 5% for many of these kind of private debt instruments. So let's very quickly, I just wanted to run you through what are the various forms of investing into private debt into India. We have this book called Private Equity, Private Debt Investments. It's probably the third book that you have on your desks. There's a chapter on page 15 on private debt investments. That sets out the advantages, etc. I think private debt investments really can happen through two routes. One is the foreign venture capital investment route, which allows you to invest into redeemable instruments. But as Vaibhav mentioned, that route is typically limited to just 8 or 9 sectors and not open for others. And the other route for making debt investments into India is under the foreign portfolio investment route. Now, what happens under the foreign portfolio investment route is that an Indian company would issue listed non-convertible debentures to a non-resident who would be registered as a foreign portfolio investor. The registration of a foreign portfolio investor has become extremely deregulated over the past few years, and today almost any non-resident can register as a foreign portfolio investor, absolutely entitled to subscribe to these bonds. Now, these bonds are listed, but the listing, you should not confuse it with the listing of an equity instrument. The listing here is just a couple of pages of disclosure. It's on private placement basis, and we have listed some of these bonds in as little as 3 to 4 days. The advantages of having these bonds is, number one, it gives you tax optimization. So whatever coupon that you give on these bonds is a deductible for the Indian company, as against other forms of upstreaming like dividends or buybacks, which might set you back by about 45% taxes. The other advantage is that, as Vaibhav mentioned, redemption or redeemable instruments are open to very few regimes and it's very difficult. But because these are really bonds, there is no challenge of redeeming them. So you can actually invest in these bonds and you can redeem them at a premium. Now, what is the premium? That you could have a bond structured in 2 ways, in a combination of coupon and redemption premium. The coupon can be a minimum downside that you need, which any PE investor would need, a 15, 16% IRR or whatever, or you could peg it up with a redemption premium, and a redemption premium being a function of any commercially agreed variable. So your redemption premium could be the underlying EBITDA of the company, underlying equity valuation, or anything. You're also not obligated to accrete these kind of coupons or redemption premium over every year. So what you could do is that you could, like suppose say in real estate, and this kind of instruments are very popular in the real estate sector because there's constant upstreaming required, or infrastructure where there's almost constant upstreaming required, where you can set out where these instruments work like form of structured equity, where if there is no cash flow in the company, there is no coupon that you pay, and there's no redemption premium. But when there is cash flow in the company, you all of a sudden pay out the coupon from it, and probably also an element of redemption premium over those 3 or 4 years, giving extreme amount of tax benefits to the company, to the investee company. We have used this not only in real estate, but also in certain sectors where there are sectoral caps like insurance, or say defense, which is kind of coming up, where there is a cap on the amount of equity that you can invest. But through this instrument, you would be able to suck out as much economics as you need. So you might as well be a 90% economic holder, even though from an equity perspective, your shareholding might still remain low. And it's also being increasingly used in forms of promoter financing, where private equity funds would fund the promoter entity of a listed company, and that promoter entity would then subscribe to the listed equity shares of its own company in the times the markets are not doing well, and the coupon and the returns on the debt are linked to the underlying equity performance of the shares that the promoter purchases from these kind of instruments. So I think there's a lot of activity around these instruments, and it's becoming very popular.
Thank you. I think that's very interesting. I think it's a new.
I have a question for
sure,
him.
sure,
though.
please. Oh, yeah.
You guys are very creative lawyers and come up with all these wonderfully complex instruments, but the issue is what happens when it goes wrong, and can you actually enforce your rights as a creditor in India? I don't think so.
So I'll answer that, Chris. And I think
Very good question.
And I think that's another reason which has been driving this. In fact, if you go to page number 16 of this paper, it sets out each benefit. And one of the benefits, obviously, is security creation. Unlike equity, where you could never create a security interest, here in this instrument, you can create a security interest in any asset of the portfolio company, whether it be a pledge, a mortgage of immovable property, receivables, or anything of that sort, through a debenture trustee or through a local trustee. On the question of enforceability, actually, you might turn out to be much better off than even, than even an Indian investor which is investing. And the reason is, as non-resident investor, you are able to get the benefit of international arbitration. I think Vyapak will cover that in the dispute resolution session. So your liability crystallization process is shortened by many, many decades to just a couple of months. And then it's only about enforcement, which is faster. We have been in situations where we've tried to enforce, and I tell you, because of the teeth that this kind of instrument gives you, we have been able to have a way through.
Yeah. So, Chris, you must wait until Vyapak finishes his talk. Okay. No, we'll catch up on that as well, because enforcement is very, very critical when it comes to, and that's why we are talking about life cycle. It's just not one part of the whole game. And, but Vaibhav, we have now New Companies Act, of 2013, and can you just tell a little bit about that and some developments in exchange control regulations also related with that?
Yeah.
So, because New Companies Act is a new creature which all of you have to come to grips with.
So, New Company Act was one of the last act by the previous Indian government. Very good intention, but bad implementation, which is what unfortunately you see. One of the things government tried to do was, they suffered with a lot of scams in India in the last few years, which a lot of you have known. And the intention of government was to kind of plug loopholes of all the scams which a lot of companies used. The New Companies Act is a result of that particular scams which people used and government trying to plug the loopholes. Unfortunate part is that they kind of painted everybody with the same brush and tried to say, this car is causing accident. Some driver is not driving well. So instead of punishing the driver, they said, let's ban driving itself. See, there won't be any accidents. So they made it a little bit restrictive. The New Companies Act is slightly restrictive from private equity perspective than what earlier it was. For example, the difference between a public company and private company has been reduced drastically. In fact, initially when it came in, there was no distinction other than a couple of distinctions with respect to independent directors and so on. Otherwise, there was no restrictions. All restrictions which are applicable to public company were also applicable to private companies. Slowly over a period of time, that restriction has been diluted, and today there are a lot more flexibility which a private company has compared to what it had at the time of introduction of this law, but it is still much less compared to what it had during the previous law. Some of the changes I will mention, both from positive and negative, both from restrictive and non-restrictive perspective. First and foremost, restrictive clauses come is on the valuation. What the Section 62 of Indian Companies Act say is that when any Indian company is issuing shares, either to Indian shareholder or a foreign shareholder, that share has to be, the pricing has to be on the basis of a third-party valuation report, which means that shareholder and investor and the company cannot decide what the pricing it would be, but it will have to be based, it will be backed up by a valuation report. Thankfully, there are no restrictions on how the valuation has to be done, so you'll have a lot more freedom on doing the valuation. But having said, still there will be a lot of question mark on, for example, what if you have a convertible instrument which will convert based on certain future parameters like EBITDA of 2015 or certain other revenue of 2016. So if you are going to decide something in the future, then it may be difficult to do so now. It was possible to do so before. It may be possible to do so now, but it won't be very easy to do so. So you will have a convertible instrument, but with a fixed pricing, a fixed convertible ratio, or a formula-based conversion may be slightly difficult to enforce. Again, the other question, other changes which came in was that you can either do rights issue or you can do preferential allotment or under ESOP. Under preferential allotment, we have these pricing guidelines. Under rights issue and ESOP, there are no pricing guidelines available. So one of the things we have started seeing now is more and more companies are going and opting towards issuing rights as opposed to issuing preferential allotment as a way of issuing shares to a private equity. So if you are going to invest, you will get this statement that, can I invest, can I issue rights issue? And you will say, no, how can you issue rights issue? I'm investing fresh. And they say, no, we are having a rights issue. There are some other investors who are investing, and then you can also invest. And the reason is that under the rights issue provision, the section allows the company, the board of the company, to say that if you have gone for a rights issue, and if some subscribers have not subscribed for shares, then you can deal with those shares in any manner you want. And this particular way of issuing shares to private equity is gaining popularity, though at this point of time, how feasible it would be really depends on facts and circumstances. Secondly, there have been a couple of changes on the investment sides. For example, earlier when any investor used to put in money, there was no obligation for a company to issue shares immediately. In fact, they could wait for 6 months for foreign investors before they can issue shares. In meantime, they could use money in the way they want to use it. Or for Indian investor, they could actually do it. There was no restriction. So which means what we used to call investors to put money as advance for share capital, which was freely usable. Now there's a restriction on that particular proceeds. So whenever investor is investing and wiring money, shares are to be issued within 2 months' time or 60 days' time. Until the shares are not been issued, money has to be kept in a separate bank account without any usage. You can't use that money till the shares are issued. Now that's something which is beneficial from foreign investor perspective because they know that company will issue shares and till then their money is safe. But that on the other hand takes away flexibility which earlier people used to enjoy. Another thing which has been brought in is there's a minimum requirement that if you are investing under preferential allotment, the par value in India has a par value concept, which could be 1 rupee, 10 rupee, 100 rupees, whichever par value you want. But the minimum value of par value of shares has to be 20,000. So total number of investment, the par value has to be 20,000 rupees. In a situation where the premium is very high, sometimes that can become a challenge. So that's something which has to be kept in mind. Yeah. I think a couple of other points. One is on the ESOPs. There have been regulations for ESOPs. If you are investing, you can't give ESOPs to founders. That's been a major different law which has come in. Other than ESOP, there have been several places where law has new provisions have been brought in with respect to class action, with respect to transferability, permitting transferability in or restricting transferability in a public company, which earlier was a gray area, which is now explicitly permissible. Similarly, different class of shares. Earlier you could do it. Under new law you could not do it, but there is at least proposal right now that private companies will allow different classes of shares. Similarly, duties of directors and some of the other provisions which have been brought in which may affect the private equity. I'm happy to discuss during question and answers if you want.
Well, thank you for that update. But Chris, I think everyone is worried about exits. So what does it take to achieve successful exits from India? You have some thoughts?
Well, I mean, it's there's a lot of factors that go into that, obviously, right?
Sure.
I mean, the obvious ones about achieving the right value, et cetera. But, some of the things that I think at least as a Western investor that underestimated were the difficulty of dealing with promoters. And if you reflect on that, at least as a Westerner, the thought of a promoter versus an entrepreneur, even the language itself is indicative of the difficulty sometimes of dealing with Indian entrepreneurs.
Sure.
In our earlier life, we had a significant number of issues with family situations. I mean, that's not something we typically face in other places. You have sort of issues of this kind of notion of dynastic shareholding, that it's going to keep going on for the family. And so, there's a lot of tension there. We're very good family counselors at General Atlantic, and so we were able to manage through a number of those. The tax issues have been terrible, right?
Absolutely.
The uncertainty around it and dealing with buyers once you actually have arrived at a situation that makes sense for an exit. That is a huge distraction. It is oftentimes, can be the deal killer in a way, is exposure on that, on indirect taxes, indemnities, all the kinds of issues that you've helped us deal with over the years. I think there's been a lack of significant strategic acquirers coming into India. So, if your only way out is the stock market, and the Indian stock market's been terrible for the last 4 or 5 years, doesn't leave you a lot of options. So you start coming up with some pretty extreme things like trying to invert to take it to another market, to take it public, because of the issues that you can't take an Indian company public in another market without being listed in India. So there are a lot of issues. So you have to be very deft, and you have to be very patient, and work over a long period of time to get yourself acceptable exit.
No, and understandable the pains people like you have been going through, and we fully recognize that. I hope things improve. But that also brings us to the next thing. Ruchir, very quickly, anything on the new exit structures you want to talk, but just don't take too much time. We have a few minutes because we want audience to also ask questions, and maybe you can, very quickly, 30 seconds.
Yeah, so I think I'll be real quick. So the only way to be quick is to refer you to what we have here. So I think one of the structures that we're increasingly seeing is what we call externalization. As Chris mentioned, I think one of the largest challenges is exit. And Indian
What is
company,
externalization? That's what you might
yeah, I was just
tell
coming.
quickly.
So externalization really means taking or setting up a holding company and bringing the Indian operating company under the fold of that holding company. So essentially taking the shareholding of the Indian company offshore. And in doing that, you get a couple of benefits. First is obviously that, once your holding company is offshore, you can take it public on whichever market. You probably get better valuations. From a tax perspective, you can do your order booking in that offshore jurisdiction and then use India for the supply, and obviously there's certain tax things you'll need to keep in mind. There's also currency comfort. Foreign investors come in dollar or whatever foreign currency denominations at the offshore level in the holding company, exit at that level. This is typically the structure that many of these investments in China have followed, where people invested into Hong Kong companies. So for the structure, on this paper, Private Equity and Private Debt, page number 75 sets out what externalization is and what are the benefits. In fact, one of the classic examples, one of the largest Indian e-commerce companies, which we flipped to Singapore, and many of the private equity investors came in there, and that has today been very helpful in terms of getting in more money and giving exits to a couple of them, and also from an IPO perspective. So Chris, you'll probably appreciate that. And I think another part is also offshore listing, which has just recently been allowed. So Indian companies can now list, Indian unlisted private companies can now list on any offshore exchange without actually being listed in India, which was a requirement. And that money, through certain structures, can be used to retire expensive private equity or private debt in that company. So even that is here in this book. If you want, you can.
Nishchal, let me quickly move on to one last question, maybe on tax issues in structuring exit. If you can just, again, very quick.
Sure. So before I talk about the tax issues, it's important to understand the taxation system of India. So India follows the source rule of taxation, where non-residents are taxed in India when they transfer shares of an Indian company. It's reverse of what US does. US does not tax non-US residents when they sell shares of a US company. So the issue which comes up typically in negotiations is when the seller is selling the shares of an Indian company to the buyer, under the Indian tax laws, the buyer is required to withhold tax before making payment of the consideration to the seller and deposit that tax with the Indian tax authorities. The question which typically comes up is, let's say if there is a Mauritius seller, and most of the investments in India have been routed through Mauritius. So if there is a Mauritius seller who is selling shares of Indian company to a buyer, whether the buyer needs to withhold tax before making payment of the consideration to the seller. Now, as per the current income tax laws read with the tax treaty between India and Mauritius, it's very clear that Mauritius company selling shares of Indian company should not pay any capital gains tax in India, and in Mauritius there is no local capital gains tax, so there should not be any tax on the transaction. However, on account of some of the issues which Rajesh mentioned on his panel, where the Indian tax authorities, especially the lower level tax authorities, are challenging the substance of the transaction at Mauritius level, the issues come up on whether the buyer should withhold tax or not. Now, if you look at it, this tax is actually of the seller, but the way the tax collection mechanism is in India, the tax is collected from the buyer. So if the buyer does not withhold tax when he makes this payment to the seller, then the tax authorities will chase the buyer, the seller will get the full consideration, and that's where the issues start. So how do they resolve the issue? There are typically 4 or 5 ways in which these negotiations happen. The first one is to get a very solid tax indemnity from the seller. Now, that's something which works well in a situation where there is a strategic seller, where the seller is a corporation and has long life. But when the private equity fund is selling shares of an Indian company, that's where the problem starts, because most of the private equity funds, they have limited life at the time when they are selling their shares in the Indian company. And in India, the tax authorities can pretty much chase the buyer for infinity. There have been case laws for that. And that's where it becomes interesting as to a buyer which has only 2 or 3 years of life which is left. How can it give tax indemnity for 7 years, 10 years, 15 years? So that's where the tax indemnity structure at times doesn't work for a private equity seller. But the structures which we have seen, especially in case of private equity sellers, are tax insurance. There are very interesting tax insurance products which are available in the market, where the insurance company will insure any taxes which are levied by the tax authorities. The premium is paid for insuring those taxes, so buyer and seller both can sleep well, and it will be the insurance company which will be paying taxes in case things go wrong. A couple of other mechanisms have been the advance tax ruling, which you can get from the Indian tax authorities for any proposed transaction or for any transaction which has happened. That's also one mechanism which has been used in the past a lot by the buyers and the sellers. However, the problem of late has been that there has been a lot of delay in giving these rulings by the advance tax authorities, which has been making some of these remedies not as effective as it would be as like tax insurance. So broadly, these are 3 or 4 remedies which are typically there, and at least 30 to 40% of the deal time is spent on negotiating tax indemnities when it comes to selling shares of an Indian company. Good for the lawyers. I understand that's where Chris spends most of his time when he's exiting from Indian companies. But yeah, I mean, again, as I mentioned, hopefully with the new government coming in, some of these pains may be reduced going forward. And, once it happens, then at least the exits should not be as painful as they have been in the past in India.
Yeah, thank you so much. I think I know tax has been the most painful point. Often we find that about 25 to 30% of time, Chris, you might tell better sometimes, more on negotiating tax indemnities than the whole agreement, right? So I think that's very strange, but unfortunately, that's a reality, and hopefully, we can resolve that. That's what Nishchal mentioned. We have about 7 minutes for question answer. What I would suggest is that because we want to give more time for the participants to raise issues, so we take the 7 minutes, then there is 20 minutes kind of a break for the tea, coffee, but if you can bring insight, then perhaps we'll continue our cup of tea or conversation. I think that if that is acceptable, it's okay? All right, so thank you. So I think that's what we'll do, but let's start with some comments or questions or anything. Most welcome. Yes, Shraddha, I can see you. Yeah, it will come all the way. You can keep it for yourself, no problem. Because he has so much experience, so I want him.
Options are not permitted to be given to founders, but in these companies, most often, the founders happen to be CEOs and COOs.
Yes.
So if you cannot compensate the CEO and COO because they happen to be founders, how are we going to attract private equity as we grow the company?
Yeah, so this is something, so let's understand the intention of the government. The intention of government was that the promoter, which typically is a majority owner in a company, they didn't want him to take the stock options because they say, he may misuse it and take more equity for him at the cost of other shareholders. That was the intention behind which the restriction was put in. Because there's no pricing restriction from stock option perspective. There is a strong push. There is a hope that government will take away this particular restriction, especially with venture capital startup companies regime. We have made a presentation through NASSCOM to the government, and government has told us that they are looking at this very, very seriously. So I think that's a hope which we feel will come through. Till then, or if it doesn't come through, we have devised with several structures which basically can achieve what you're looking at. For example, the trust structure. What one can do is you can issue shares to a trust, and then trust can issue units to someone else. Alternate mechanisms can be done. What you had the founder share concept in the US, where you issue shares to the founders, and then in case he leaves early, then you he has to give it back to the company. Somewhat similar structure can be done, basically the reverse ESOP methodology. So some of the structures we have identified which may work. Yes, you want to have a clean ESOP, which may not be possible at this point in time. In future, it may be possible, but till then, we have to live with these alternate structures which are workable, not as clean as ESOP.
I think in short, Vaibhav is saying is that, on the face of it, nothing is possible in India. But if you have a good law firm on your side, everything is possible. And, so I think that's the most important message you must take away. And, any other question or comment for the time being?
I have a comment.
Can you tell your name and?
Vibhuti Jha.
Yeah, Vibhuti.
My question is designed with an intent that there are no bad questions, only stupid answers. So I'm asking this question is because India ranks way low in terms of ease of doing business. How will these legislations and what you are talking about, do we go up? How much? And what we need to do, what does India need to do to make a quantum leap? Because India does not need incremental changes. What we need is truly transformative part of the work. So as a very august law firm that you are, and to keep your job intact, and what does Indian law system need to do to up it from 143 to say 100? In what time?
So let me answer this, and maybe other people can add depending on time. See, India is 134. Government has said that we need to go below 100. I think that's the mandate in next 12 months. That's the mandate which Prime Minister has given. Government is actually looking for, Prime Minister has asked each ministry to list down 5 simple things, which is what they call low-hanging fruit, which they need to achieve to make life simple for their areas. So for example, in IT industry, the minister is going and talking to people and say, what are the 10 things you need which will make life simple for you? and everybody has made representations, and they have taken the representations and given to the government. We expect some of them actually came through in the budget to some extent on tax perspective, but for non-tax perspective, we expect that in the next 6 months, you will see a lot of changes. Some changes, for example, will be on automizing a lot of things. So, one of the major frustration has been that some Indian bureaucrat goes out and stops, for example, simple thing like incorporation of a company. Now, everything is going to be made online and automatic and reduce the discretion of Indian bureaucrat. So that is one process which the Prime Minister is very keen on pushing. Similarly, he is looking at those steps which are very specific, very clear, measurable, and he's going to measure for each ministry to see what they have done. So that process is on.
Yeah, and in fact, the Prime Minister already has a good track record in his erstwhile avatar of being the Chief Minister of Gujarat, where what he did was he made all the approvals online. So all the major approvals which are required, there is no human intervention. And since there is no human intervention, there is no scope for corruption. So that's something that he successfully did in Gujarat, and he has already started the process for some of the infra projects. He has given a clear instruction to to his teams that all the infra projects should be done through e-auctioning. He again doesn't want human intervention in clearance of some of these projects. So that's something that he's cognizant about, the fact that the more automation it does, less human intervention, less corruption, lesser number of approvals, and that's the only way to bring India from 134 to below 100.
And we are very closely working, and like associated like NASSCOM, CII, IVCA in venture capital, each one is putting their proposal. And we're very closely working with a lot of those companies to put proposal for purpose of easing doing business in India.